Hello everybody, this will be a video on stop losses, how to use them and how to implement them when trading and using good risk management. In my opinion, stop losses is like the backbone to any risk management plan that you have. Without using a stop loss, you can pretty much lead your account into bankruptcy and wipe out your whole account. If you guys like any of this video, please give me a like and a thumbs up. It is greatly appreciated and it allows me to make more content like this. Anyways, starting off, a stop loss can be looked at as anywhere in a uptrending market. I'll start off by describing basic market structure. And so here you have a higher high followed by a higher low, higher high, higher low, higher high. And so say that you have a horizontal line. Oh, that's kind of bad. Horizontal line right here. And you base your entry based on this price right here. So this is when you enter. A stop loss can be put right below that lower low, that previous lower low, and your stop loss is determined, or your position size should be determined based on how much you are willing to risk, meaning how great that stop loss is. And so based on how much I am willing to risk, my position size should be calculated based on my stop loss amount. So if, say, I have $100,000 that I'm trading with, and good risk management is practicing by only risking 1% of my trading capital. So I'm risking $1,000, willing to lose that. And so if I pull up my calculator here, if I have a 0.044% stop loss, and so I am willing to risk 1000% divided by stop loss percentage. So it'd be 0.0044. And so I can have a position of $227,000 basically, and I'm still only losing 1% of my trading capital. That just shows you how powerful leverage could be if you want to have a position size that large. But I'll use a different example. Basically, a common thing is that people like to use the same percentage for a stop loss over and over again, and that is not a good thing to do, especially when markets tend to start stop loss hunting, and I'll get into that later on in the video. But let's just say I have a 1% stop loss. Ignore my drawing for right now, but let's calculate that out. So $1,000, risking 1% of $100,000, my total capital for trading. And so I divide it by 0.011%, which is my stop loss. So I can put $100,000 on the trade and still be only losing 1% of my trading capital, or $1,000 in this. Now, moving on to a different example, let's say price is kind of going up and down, mainly consolidating a good trading range. And say I am wanting to long on based off of this golden pocket, basically a support I believe price will bounce off of, and I want to practice good risk management, and so I want to have a stop loss. Where would I put that stop loss? Well, one of the ways you can put the stop loss is underneath the next swing low, or you can put it underneath the next fib level, which you believe that will be the next support level, and that is the 786 in this case. And so usually you wouldn't have this small of a stop loss. You'd have a greater stop loss, but this is a stop loss just below the 786. And so it's the next support level, which will save you in case price does break a Fibonacci level. Now let's use more of a real use example. Let's say you have a basic trend line and you just draw it touching the supports. And so you are following a trend where you're making higher highs, higher lows, higher highs, higher lows. And right here would be your entry. Say you decide to enter right here. And so I'll draw a long position. Let me delete some of this. And so what you would do is put your stop loss underneath the next support level. And so in this case, it would be right around here, or where price last touched a previous support level, which is basically this trend line. And so based off of this, you would have a 6.3 stop loss. And so to calculate out your position size again, practicing good risk management. So you're only risking 1% of your account. So you're risking only $1,000. So with this, $1,000 divided by 6.35%. So 0.6 or 0.0635. And so you'll have around a $48,000 position in which you would enter, and you would just go from there and take profits at your next possible resistance level. And another thing to do with your stop loss too is whenever you take a hit profit or you reach a resistance where you're taking part of your position out or a lot of it, what you can do is move your stop loss to your entry price. This allows you to have a risk-free trade, and in case you do get stopped out, you won't be losing any money, along with your market order fees for the stop loss will be covered as well. Let's use another real world example. Let's say we are shorting, and this will be based on a fib extension example. And so let's say I am trying to short based on this golden pocket right here. And so I would open up a short position, have my entry based on the 618, and I would move my stop loss just above the 786. And so in this case, I would have a 1.45% stop loss. And so to calculate out my position size, we're going to use the same thing where I have $100,000 as my capital that I'm trading with. Only want to risk 1%. And so to calculate our position size right here, we have $1,000. And so we have a 1.45 stop loss. And so we'll take 1,000 divided by 0.045. And so we can have a $68,965 position, which is a pretty big position. And so one last thing is that people sometimes don't like to place a stop loss because sometimes their stop loss can get wigged out. And so this is kind of takes more management of your trades, where you place a mental stop loss at a certain price. And so say if price does end up coming above where my intended stop loss would be, I would exit out at this price. And what you can do is set an alert on whatever exchange you are using. And so in this case, Bitcoin. And so I can use an alert if Bitcoin is crossing $500, and so I can create an alert, and when price does come up towards this, I can quickly hop on and exit out of my trade. Thank you for watching the video. A stop loss is necessary, especially for a invalidation point, and a stop loss is necessary to practice good risk management so you don't end up losing your whole account based off of one trade if a trade doesn't go in your favor. Also, remember to calculate out your position size. And so your position size should be how much you are willing to risk in your total capital divided by your stop loss percentage. And so that will calculate out your position size. Remember to give me a thumbs up and subscribe if you guys like the content. Also, I'll be leaving notes on what to do in the description, along with a link to a free Discord where I post all my trades in. Thanks. Bye.